Markets rarely announce their biggest turning points with a trumpet blast. More often, they whisper through subtle shifts that most investors dismiss as noise until those whispers become undeniable trends. And that possibility is exactly what makes the current landscape surrounding gold and silver so compelling. Across global financial markets, a combination of persistent inflation concerns, elevated government debt, uncertain monetary policy, geopolitical tensions, changing central bank reserve strategies, and increasingly fragile investor confidence has created conditions unlike those witnessed during many previous economic cycles. While equity markets continue searching for fresh momentum and bond markets wrestle with shifting expectations surrounding interest rates, precious metals have quietly reclaimed their role as strategic financial insurance rather than merely speculative assets. Gold, represented globally through XAU/USD pricing, continues to command attention as investors attempt to determine whether recent strength marks another temporary rally or the early chapters of a much larger structural bull market. At the same time, silver, reflected through XAG/USD, sits at an equally fascinating crossroads, balancing its traditional monetary characteristics with its expanding industrial importance in renewable energy, electrification, semiconductor manufacturing, and advanced technology. The relationship between these two metals is becoming increasingly important because their movements are no longer driven by a single narrative, but instead by multiple overlapping forces reshaping the global economy. Every inflation report, every employment release, every central bank speech, every Treasury auction, and every geopolitical headline now carries the potential to reshape expectations across precious metals markets. Investors who once focused exclusively on quarterly earnings are increasingly examining macroeconomic indicators that influence currency purchasing power and long-term wealth preservation. The Federal Reserve remains central to this discussion because monetary policy continues to influence the opportunity cost of holding non-yielding assets, such as gold. Higher interest rates traditionally increase the attractiveness of fixed-income investments while placing pressure on precious metals, yet recent market behavior demonstrates that this relationship has become more nuanced. Even during periods of elevated policy rates, gold has displayed remarkable resilience, suggesting that investors are evaluating broader risks, extending beyond simple yield comparisons. Massive fiscal deficits, expanding sovereign debt burdens, and questions surrounding long-term currency stability have encouraged institutional investors to reconsider strategic allocations toward tangible stores of value. This shift is occurring simultaneously with record levels of central bank gold purchases across numerous emerging economies, reflecting an ongoing diversification away from excessive dependence on reserve currencies. Although central bank buying alone cannot guarantee permanently higher prices, sustained official sector demand creates an important layer of structural support beneath the market. Unlike speculative flows that can reverse rapidly, reserve management decisions often unfold over many years, reinforcing long-term trends rather than short-lived price spikes. Meanwhile, inflation continues to occupy a complicated position within the global economic narrative. Headline inflation rates may fluctuate as energy prices and supply chains stabilize or deteriorate, but underlying price pressures often remain more persistent than policymakers initially anticipate. Services inflation, wage dynamics, housing costs, and demographic changes all contribute to an environment where inflation may prove stickier than historical averages. If inflation remains elevated while economic growth slows, policymakers could face increasingly difficult decisions regarding interest rates. Maintaining restrictive monetary policy risks slowing economic activity further, while premature easing could reignite inflation expectations. Such policy uncertainty frequently benefits gold because markets often seek assets perceived as independent of government liabilities. Silver, while influenced by similar monetary factors, introduces another dimension through industrial demand. The accelerating transition toward electrification requires significant quantities of silver for solar panels, electrical infrastructure, advanced electronics, and high-efficiency technologies. This creates a unique dual demand profile in which economic weakness may temporarily reduce industrial consumption, while investment demand simultaneously strengthens amid financial uncertainty. Understanding silver therefore requires balancing cyclical manufacturing trends against structural technological expansion. Bond markets offer another essential signal for precious metals investors. Treasury yields reflect collective expectations regarding inflation, growth, and future monetary policy. Rising real yields have historically presented headwinds for gold, but the interaction between nominal yields, inflation expectations, and financial stability has become increasingly complex. Episodes of banking stress, liquidity concerns, or sovereign debt anxiety may encourage safe haven flows into gold even when yields remain relatively elevated. Investors are therefore paying close attention not only to the absolute level of yields, but also to yield curve dynamics, credit spreads, and broader measures of financial conditions. An inverted yield curve has frequently preceded economic slowdowns, reinforcing arguments that defensive portfolio positioning deserves renewed consideration. Currency markets further amplify these relationships. The strength or weakness of the US dollar significantly influences global precious metals pricing because gold and silver are primarily denominated in dollars. A strengthening dollar often creates headwinds by increasing the effective cost of metals for international buyers, whereas a weakening dollar frequently supports higher prices. However, recent years have demonstrated that simultaneous appreciation in both gold and the dollar can occur during periods of elevated global uncertainty, highlighting gold's function as both a currency alternative and a safe haven asset. This evolving correlation illustrates why investors increasingly rely upon broader macroeconomic frameworks rather than simplistic historical rules. Institutional participation also deserves careful examination. Large asset managers, hedge funds, pension funds, sovereign wealth funds, and exchange-traded products collectively influence market liquidity and sentiment. Positioning data often reveals whether institutional investors are becoming increasingly optimistic or cautious regarding precious metals. Although speculative positioning can generate significant short-term volatility, long-term trends typically emerge from sustained strategic allocations rather than rapid trading activity. Many institutional investors now frame gold as portfolio insurance against systemic uncertainty rather than solely as an inflation hedge. This subtle distinction matters because systemic concerns encompass geopolitical fragmentation, financial instability, cyber risks, debt sustainability, and potential disruptions within international trade. Retail investors approach these markets differently. Individual participants frequently react emotionally to sharp price movements, chasing rallies and abandoning positions during corrections. Yet history repeatedly demonstrates that successful long-term investing often requires patience during periods of consolidation. Gold has experienced numerous temporary declines throughout major bull markets, each testing investor conviction before longer-term trends resumed. Silver has displayed even greater volatility, producing dramatic rallies followed by equally significant corrections. This higher volatility can create substantial opportunity, but also demands disciplined risk management. Geopolitical developments continue adding another layer of complexity. Conflicts involving major economies, disruptions to energy supplies, sanctions, trade disputes, shipping interruptions, and regional instability all contribute to heightened demand for safe haven assets. While predicting specific geopolitical events remains impossible, their cumulative impact reinforces the strategic case for diversification. Markets dislike uncertainty, and precious metals have historically benefited when uncertainty expands faster than confidence. The modern global economy is increasingly interconnected, meaning localized disruptions can rapidly influence commodity markets, supply chains, inflation expectations, and investor psychology across continents. Another important consideration involves the unprecedented scale of global debt. Governments worldwide have accumulated enormous fiscal obligations over many years through stimulus programs, infrastructure spending, demographic pressures, and emergency responses to economic crises. Servicing this debt becomes increasingly challenging when interest rates remain elevated. Consequently, policymakers may eventually face incentives favoring moderate inflation over prolonged fiscal austerity. Such an environment could gradually erode purchasing power, encouraging continued interest in real assets capable of preserving value across extended periods. Gold has historically fulfilled this role during numerous monetary regimes, surviving currency reforms, recessions, financial crises, and geopolitical transformations. Silver, although more volatile, has similarly maintained purchasing power over very long horizons while participating in periods of rapid industrial expansion. Historical comparisons provide valuable context but should never be interpreted as guarantees. The inflationary environment of the 1970s, the technology-driven expansion of the 1990s, the financial crisis of 2008, and the pandemic-era stimulus period each presented unique combinations of economic conditions. Today's environment incorporates elements from multiple historical episodes while introducing entirely new variables such as digital assets, artificial intelligence, supply chain restructuring, and accelerating energy transitions. Consequently, investors should remain cautious about assuming perfect historical repetition. Instead, understanding recurring behavioral patterns, such as the search for safety during uncertainty or the preservation of purchasing power during inflation, may prove more valuable than seeking identical price trajectories. Market psychology often exerts greater influence over short-term price movements than underlying fundamentals. Fear of missing out can drive rapid inflows during rallies, while panic selling frequently accelerates declines beyond levels justified by fundamentals. Successful investors attempt to distinguish temporary emotional extremes from genuine structural changes. Gold's reputation as a defensive asset sometimes encourages unrealistic expectations that prices should rise continuously whenever uncertainty exists. In reality, precious metals experience normal corrections, even within constructive long-term trends. These periods often reflect profit-taking, liquidity needs, or temporary shifts in monetary expectations, rather than permanent changes in underlying demand. Technical market structure also influences price behavior. Important support and resistance levels, moving averages, momentum indicators, options positioning, and futures market dynamics all contribute to short-term volatility. Nevertheless, technical signals tend to prove most effective when interpreted alongside macroeconomic fundamentals, rather than in isolation. Strong technical breakouts supported by improving macro conditions generally carry greater credibility than price moves occurring without fundamental reinforcement. Investors therefore increasingly integrate technical analysis with economic data, rather than relying exclusively on one methodology. Looking ahead, several scenarios deserve consideration. In a bullish scenario, inflation remains moderately elevated while economic growth slows, encouraging gradual monetary easing alongside persistent concerns regarding debt sustainability and geopolitical risks. Under such conditions, declining real interest rates combined with continued central bank purchases and improving investor demand could support higher gold prices, while silver benefits from both monetary demand and industrial expansion. In a bearish scenario, inflation falls convincingly towards central bank targets, productivity improves significantly, economic growth accelerates without renewed price pressures, and real yields remain attractive. Such an outcome could reduce urgency surrounding defensive assets, encouraging capital rotation toward higher-yielding investments. Even within that framework, however, structural central bank demand and fiscal uncertainties could limit downside relative to previous cycles. A neutral scenario appears equally plausible, characterized by alternating optimism and concern, producing extended trading ranges punctuated by periods of heightened volatility. During such environments, disciplined portfolio diversification often becomes more valuable than attempting to predict every short-term price movement. Risk management remains essential regardless of individual market outlook. Precious metals should generally complement diversified investment strategies rather than replace them entirely. Position sizing, investment horizons, liquidity requirements, and personal financial objectives all influence appropriate exposure. Long-term investors frequently emphasize gradual accumulation over aggressive market timing because accurately predicting short-term fluctuations consistently remains extraordinarily difficult. Dollar-cost averaging, portfolio rebalancing, and disciplined risk controls may ultimately contribute more to investment success than perfectly forecasting macroeconomic turning points. Another emerging consideration involves global reserve diversification. Numerous countries continue exploring methods to reduce concentration risk within foreign exchange reserves. While reserve currency systems evolve slowly, incremental diversification into gold represents an observable trend reflecting broader strategic considerations rather than immediate market speculation. This official sector behavior reinforces perceptions of gold as a neutral reserve asset independent of any single government's fiscal policy. Digital innovation introduces both competition and complementarity for precious metals. Some investors view cryptocurrencies as alternative stores of value, while others continue preferring physical assets with thousands of years of monetary history. Rather than assuming a zero-sum relationship, markets increasingly accommodate both asset classes within diversified portfolios, each serving different risk preferences and investment philosophies. Environmental considerations also influence mining economics. Developing new gold and silver production requires substantial capital investment, regulatory approvals, exploration success, skilled labor, and energy resources. Declining ore grades, permitting challenges, and rising production costs may constrain future supply growth even if prices strengthen. Supply limitations, when combined with sustained investment demand, can amplify long-term price trends. Nevertheless, mining equities introduce company-specific risks distinct from owning physical metals or exchange-traded products, including operational execution, political exposure, cost inflation, and management decisions. Investors should therefore distinguish carefully between commodity exposure and mining company exposure. Ultimately, the precious metals story extends beyond daily price fluctuations. It reflects broader questions regarding confidence in monetary systems, fiscal sustainability, geopolitical stability, technological transformation, and long-term wealth preservation. Gold and silver continue occupying unique positions because they bridge history and modern finance, serving simultaneously as commodities, monetary assets, industrial materials, and psychological anchors during uncertain times. Whether current market conditions evolve into a sustained secular bull market or an extended period of consolidation will depend upon interactions among inflation, central bank policy, economic growth, currency dynamics, fiscal discipline, and investor sentiment. No single indicator can provide definitive answers, making flexibility and continuous analysis more valuable than unwavering certainty. Investors willing to monitor macroeconomic developments with patience rather than emotion may find themselves better prepared regardless of whether markets ultimately reward optimism or caution. As always, the most informed decisions emerge from understanding probabilities instead of chasing predictions, recognizing that financial markets continuously evolve as new information reshapes expectations. If you found this analysis valuable, share your perspective in the comments. Let us know whether you believe gold and silver are entering a new long-term cycle or simply navigating another temporary phase. And consider subscribing for more in-depth market analysis covering precious metals, macroeconomics, and global financial trends. This presentation is intended solely for educational and informational purposes and should not be interpreted as personalized financial, investment, legal, or tax advice. Always conduct your own research and consult a qualified financial professional before making investment decisions, as all investments involve risk, including the potential loss of principal.